Donald Yacktman has beat 99% of his rival fund managers over the last 10 years by sticking with quality stocks. The Yacktman fund is up 42% year-to-date, far outperforming the S&P 500. We're pleased to have Don join us now from Austin, Texas, with some insight into investment strategy. Don, pleasure to have you.
I'm fine. Good to be with you.
So, what's the secret to your success, if you will?
Well, we view all stocks as if they were bonds. We look at a forward rate of return and we look at a quality level, and then we try to, in effect, buy things that are on a risk-adjusted basis the most attractive. We also like to get a good business if we can, and a good management if we can. How does that translate in these volatile times? What names in particular? Okay, well, volatility is really the friend of a value investor because it opens up spreads and creates outliers, if you will. And like a couple of years ago, it seemed to us that we really weren't going to be rewarded for taking any additional risk on, so we were in the very high quality kind of things like Coke and Pepsi and so on. And then about 6, 8, 10 months ago, things really started to open up, and it led us toward individual stocks that really were a little less in quality but had enormous spreads relative to the high quality things. So some of the financial things, some of the media things, some of the retailers, Liberty Media, which QVC, Abercrombie and Fitch, Williams Sonoma, even some of the big banks like Bank of America and Barclays briefly, and some of the media, News Corp, Viacom. But now we've almost flip-flopped again back to what we think are the high-quality names, the Cokes, Pepsis, Proctors of the world.
Mr. Yacktman, is Mark Crumpton with Lori. Your fund, you're looking more at valuations as opposed to betting on the U.S. economy. Tell me about that strategy.
Well, yeah, we do not look at the market or the economy or interest rates, inflation, the stock market, none of that. We just really focus on individual business properties and looking at the forward rate of return we estimate that we will earn if we hold it indefinitely. And we look at the quality rating and try to do that on a risk-adjusted basis.
And Mr. Yacktman, you know that a lot of your competitors, they really do look at the macro situation, but you're saying you don't. Does that place you in the minority?
I guess it does. We're just, I guess you'd call us bottom-up investors is the buzzword. But as my son says, we're dumpster divers. So we just look for the outliers, but there aren't that many of them right now.
How often are you adjusting positions?
It depends on what happens in the marketplace and the valuations. I mean, you know, News Corp has virtually doubled this year, as an example, and others have done even more than that. AmeriCredit, which was a big position of ours, is one of the few financials that's up over the last couple of years. So it just depends. It really is a function of what the market allows, and we try to just not try to force it, but react to what the opportunities are.
Is the S&P overvalued right now? A lot of the people that called the March low are now saying, boy, stocks have come too far too fast. Where do you stand on that debate?
We just don't think in those terms. We look at individual properties as opposed to the market itself.
But you just told us you don't know what's going to happen, so I'm just trying to get a feel for what you think is going to happen. Maybe it's a crystal ball question, though.
Yeah, well, what I would say is that yes, we've had an enormous run, and so I think the valuations aren't nearly what they were at the early part of this year. And so that's what drives us toward more quality. So we have, in effect, I guess you'd have to say our position, although we get it by looking at it individually, we have more cash and we have more high-quality businesses that are typically very defensive. But it's just we get there differently than most people do.
Don Yacktman, we have to take a commercial break, but we'll continue with our discussion right after this. And we are back with Donald Yacktman, who's beat 99% of his rival fund managers over the last decade. Don joins us live from Austin. Welcome back, Don.
Thanks.
All right, obviously, as a value fund investor, that is your expertise. But given that we may be in the early stages of economic recovery, would you sample some growth names?
Well, again, nobody would, I mean, everybody would like to have more growth if they can get it. At least we would. And, I mean, some of the names we have used to be considered growth names, certainly like Microsoft and Pfizer and Coke and Pepsi.
That's an interesting phenomenon.
I guess it depends on your definition.
exactly how some of these growth names have now sort of evolved into value. Are you seeing that now that we're in a different economic landscape?
Well, again, it's just the valuations of what we try to do. And usually we're typically buying things that have been out of favor in the short term, but we think long term have very good forward returns. And so we're almost the opposite of about 70% of the investors who are momentum investors. They tend to buy things that have been hot or what have been good. We tend to favor things that have been the other way.
Mr. Yacktman, your fund, you spent most of the past decade in a defensive position, lots of cash. Tell us about how that positioning has set you up to move aggressively now in these economic times.
Well, again, it depends. You know, there have been times when we have been out of cash totally. And, I mean, early this year we were totally out of cash. In 2002, we actually had, in the focused fund, we had a negative cash position at one time. So it just depends. If the values are out there, we'd rather be owners. We don't want to be creditors.
What should an average investor's asset allocation pie look like these days?
Oh, I think they should have all their money in the Yacktman focused fund.
Well, that's a given. But if I can't afford your fees, how should I be invested?
Well, like I said, right now, I think I would look at things like Coke and Pepsi, or you know, we have Microsoft, Pfizer. I think those things all look still pretty attractive at these market levels.
And if I might ask you briefly, sir, a lot of your media companies, you like them, but they actually haven't been the darlings of a lot of other funds. What are you seeing that other folks aren't?
Well, we're looking, again, long-term. I think, like News Corp has some really excellent business properties. They have some clunkers in there, but they have some excellent business properties. I mean, the Sky TV and Fox and networks and so on, Fox News, they've done very well. You know, one of your competitors, I guess, but they've done very well.
Right.
And I think, like Viacom, you've got Nickelodeon and MTV and Comedy Central. Now, Paramount hasn't done much for them, but they have a huge library. So, I mean, again, we just look at the valuations and the forward rates of return, and those have come up. They're not as attractive as they were, but they're still very big positions for us.
What's been surprising to you in terms of what's had the best valuation?
What's been surprising?
Yeah, any particular company that's had a real good valuation compared to its peers that you thought, oh, hey, that's a good buy right now in terms of, you know, for your checklist?
Well, again, I come back to the ones I mentioned, you know, Pepsi, Procter, Coke, Pfizer, Microsoft. All these have really been sluggish in the recovery over the last several months, and so they've been kind of left in the dust, but they're really pretty good values.
Do you like
long-term.
Dividend paying? Do you look at that closely?
We look at the capacity to pay dividends. In other words, it's really the cash flow the businesses generate that's important, not that they pay it all out. I would rather have them reinvested if they can find good places to reinvest it, but not do dumb things with it.
Right. Donald Yacktman, founder of Yacktman Asset Management, joining us this afternoon from Austin, Texas. Mr. Yacktman, thanks.